Hi everyone, welcome to this week's Advisor Market Update. This week highlighted the persistence of AI leadership, strategic corporate restructuring, and emerging opportunities in credit markets. From technology platforms extending their dominance to global expansion through structural transformation. Here's what advisors need to understand about the evolving market dynamics. Let's dive into the signals from the street. Starting with technology leadership, NVIDIA continues to demonstrate its AI infrastructure dominance. Stifel raised its price target to $212, citing accelerating demand for the company's GB300 platform. This platform specifically addresses inference computing, where enterprises move beyond AI training into actual deployment at scale. With 58 of 65 analysts maintaining buy ratings, the consensus view remains NVIDIA's competitive moat keeps widening. For technology allocations, this reinforces focusing on companies that control critical infrastructure rather than those merely consuming AI services. Moving to consumer goods, Keurig Dr Pepper made a significant strategic move. They are acquiring JDE Peet's for $18 billion and planning to split their beverage and coffee businesses into separate companies. This dual approach represents more than portfolio optimization. The JDE Peet's deal provides immediate access to both European and Asian markets, where premium coffee consumption continues expanding. The planned split also allows each business to pursue distinct growth strategies without capital allocation conflicts. It demonstrates how traditional companies can unlock value through strategic geographic diversification and structural reorganization. In financial services, Lazard got upgraded to outperform by KBW with a $65 target. The firm highlighted improved client inflows and a $10 billion plus advisory pipeline. This reflects broader expectations for deal activity normalization as financing costs stabilize and corporate confidence returns. Lazard's productivity improvements position them to capture outsized revenue when transactional volumes recover, particularly in middle market deals where relationships drive premium pricing. Looking at the macro environment, Treasury markets are navigating inflation uncertainty with increased Fed flexibility. Yields edged higher ahead of Friday's PCE print, with the 10-year climbing to 4.29%. Powell's Jackson Hole commentary acknowledged shifting risks towards labor market weakness rather than persistent inflation. This subtle pivot creates opportunities for duration positioning, particularly if inflation data confirms the disinflationary trend while employment softening accelerates. However, not all sectors benefited from policy clarity. Orsted shares plunged nearly 20% after the US government halted work on its Revolution Wind project. This regulatory shock highlights the vulnerability of sectors dependent on government support, particularly as political priorities shift. The $9 billion rights issue now in jeopardy demonstrates how quickly regulatory changes can impact capital deployment in infrastructure-heavy industries. In fixed income, corporate credit markets are presenting tactical entry windows. Just one U.S. investment-grade bond sale launched this week, despite strong investor demand and spreads near historic lows. This supply-demand imbalance creates opportunities for quality credit positioning. The light issuance calendar reflects corporate caution about market timing rather than funding needs, suggesting companies are waiting for optimal windows while investors search for yield. This environment favors selective credit picking in high-quality issues, as scarcity premium could support spreads even if broader rates rise. This week's signals reveal multiple layers of opportunity. Technology infrastructure continues consolidating around dominant platforms like NVIDIA. Strategic corporate restructuring in consumer goods demonstrates value creation through focused execution. Financial services positioning for M&A recovery show confidence in normalized deal activity. And credit markets are offering tactical windows amid supply constraints. The common thread is companies and sectors with strong fundamentals are navigating these transitions successfully while creating opportunities for selective positioning. Thank you for watching, and we'll see you in the next update.